Welcome to our weekly lecture. I am not a social media person, but my social media guru, Hotai Media, that's my brother, has said that we should probably try and put something on the channel, the YouTube channel, once a week. And so that's been my goal, and I've been kind of hitting that mark. So who knows if I'll continue to hit that mark, but that is kind of the plan. Today's lecture to be posted to the YouTube channel is on secondary markets. It's appropriate for those who are taking their SIE and those who are taking their Series 7 top-off exam. The difference usually when I'm posting lectures and telling it's for both, I mean, I could very well say this is appropriate for 65 as well, but more appropriate SIE and top-off. Usually top-off has a little more depth and quantity than the SIE on these subject areas. At some point, I'll exhaust, lectures that work for more than one exam. For example, I haven't posted lecture 4 of options. I'm going to post that as, and conduct that lecture as a Series 4 or 9. Give me an excuse to, give some pointers to those who are taking the 4 or 9, even though it'll still be a Series 7 top-off, lecture. So that's kind of where we're at. I also going to post at some point, Dean does the FINRA SIE exam, where I'm going to, share the screen and actually go through the SIE FINRA practice exam. I'm going to do a lecture on types of orders, market limits, stops, other qualifiers like all or none, fill or kill, that kind of thing. That would be appropriate for all exams. So those are some lectures that are coming. I got one for mnemonics. I'm taking the Series 7. So think of it as coming previews or coming attractions or previews. Okay, so let's get started with today's discussion. I could have very easily decided to do the primary market before I talked about the secondary market. I mean, that would be the natural sequence because the primary market does precede secondary market because, the primary market is where issuers receive the proceeds. And then once the issuer receives the proceeds, then those securities will be trading in what we call the secondary market. The two major pieces of securities legislation, are 33, sometimes referred to as let me get my annotation tool here, the Paper Act. Sometimes you can get questions right by covering up the screen and saying, are they asking about paper, prospectuses, 33? Or are they asking about people and places, 34? Those are our two major pieces of securities legislation. Those were passed by President Roosevelt's Congress, and all that legislation was called the New Deal, kind of hint that the old deal was not so bueno. Prior to 33, it was trust me, you'll love it. President Roosevelt said with 33 and 34, I'm going to change the securities industry from let the buyer beware, caveat emptor, to let the seller beware. You, the seller in the securities industry, need to make sure you do it correctly. 34 created the SEC. And under the theory that a best gameskeeper is a reformed poacher, he made Joe Kennedy, President Roosevelt made Joe Kennedy the first chairman of the SEC. And they said, how could you put a, fox in charge of the hen house? And he said, well, who better than a reformed poacher? Anyways, all those transactions collectively where the issuer receives the proceeds is called the primary market. I think a good analogy is the art market, right? I said, did you get that as a primary transaction? Did the artist receive the money? I had a client, she prided herself on that in her art collection, they were primary transactions. That she's not a patron of the art, she's a patron of artists. She would buy them from them, the artist would receive the money. I had to point out a couple exceptions. I said, well, that person I know is no longer around. You must have got that in the secondary market. In the secondary market, the proceeds are going to the previous owner. And I think a good example would be Gauguin, right? Gauguin did not get $30 million for the painting. Gauguin got $30 from some tourist in Tahiti. The $30 million is going to the previous owner. Now, if you're buying art in the art market, you can do it through an art dealer who has inventory. We'll be talking about that. Or you can do it in an auction where they're just matching buyers and sellers. They're not trading against customers. They're just taking commissions. And we'll be talking about that at length. Here, I've given you the common kind of version of this. And what I mean by that is, typically we're going to do the primary transaction, a private placement. And a private placement, the big one is primarily Reg D. 33 says if you're going to sell brand new securities to the public, what kind of securities? Brand new. To whom? The public. You have to make a registration statement. Now, the exemptions available, there are a bunch of them, but one of the exemptions available is Reg D, where I say to the SEC, I did sell brand new securities, but I did not sell them to the public. It was an investment by invitation only. And, I only invited institutional investors or accredited investors. Accredited investors, very testable. This isn't the Electron primary market, but that's $1 million net worth exclusive of primary residence, or 200 grand for the last 2 years and the expectation of 200 grand this year, or married and filing jointly, 300 grand. And, those are the kind of folks that would be in a private placement. Now, what's really important for those people who partake in a private placement is to know that they're buying unregistered securities. Unregistered securities. Securities had never gone through that 33 process. Restricted. And they're called restricted because they're restricted in terms of their transfer. In the old days, when we had stock certificates, if you got stock in this kind of a transaction, that stock certificate would have nasty red letters on it that would say stop transfer. I said, ooh, you must have got this in a private placement. How long have you had it? Because what I'd like to do is get that nasty red letters removed. And very much a test issue, You have restricted transfer for 6 months. That is very much a test question on both exams. So, then once we raise this private money, for example, SpaceX is privately held. They've raised $5 billion in private placements by selling unregistered stock that has restricted transfer to it. Now, eventually, if SpaceX goes public and there's a public marketplace for those securities, you might want to sell those securities into that public marketplace. And before you do so, you would have had to held those for at least 6 months. And then we do what's called our S1 registration statement, saying that now we are going to be selling brand new securities to the public, and we're entering the cooling off period of quiet time. Now, as part of that, I say, okay, well, listen, if I can't get you an IPO allocation, you can still buy this stock in the secondary market, New York or NASDAQ. I'm recording this lecture today, and today a firm went public. And a firm chose as their secondary market NASDAQ. And so I said, well, listen, if you miss the IPO allocation, you can certainly step into the secondary market, NASDAQ, and get that security there. So as part of that process, the issuer is going to decide whether they're going to register their stock or which stock exchange, which secondary market they're going to choose, either New York or NASDAQ. And then today a firm chose NASDAQ. Nearly doubled off the IPO price. IPO stands for instant profit opportunity. No, I'm joking. Stands for it's probably overpriced. No, stands for their initial public offering. So that's typical that we make that. Now we have what are called registered securities that have gone through that process. So, I'd be prepared on the exam to be encounter the term unregistered or restricted stock. I would definitely know the way you remove the restriction is by holding it for 6 months. I would know the two preeminent markets in the secondary market are New York and NASDAQ. And, when New York and NASDAQ come to pitch the board of directors about whether they should trade on New York or NASDAQ, they say, what are the advantages to those markets? Now, we'll be talking at length about both these markets in more depth. Right now, we're just kind of getting an overview. But, in 1792, there were no electronics. There were no telephones. And if, I'm talking to George Washington there in Tidewater, Virginia, George Washington was involved and participated in the primary offering for Bank of New York. Bank of New York is older than our country. And if he wants to turn the Bank of New York stock back into money, I said, well, George, I've checked with all the locals here and they're like you. They're all real estate rich and cash poor. I haven't been able to find you a local buyer. I say, George, are you familiar? Are you familiar with the New York Stock Exchange? Are you familiar with the New York Stock Exchange, one of the most successful cartels ever created? He goes, well, Dean, I am. I was inaugurated on the front steps. And I said, well, George, as you know, they conduct an auction every day there between 9:30 and 4 o'clock where they match buyers with sellers. Unfortunately, I'm not a member and you can't participate or attend the auction unless you're a member. And unfortunately, I'm not a member. And so we're going to have to go through one of those members and they can execute that order for us, and they're going to want a commission. Very testable to know that the New York Stock Exchange can best be characterized as an auction order driven market. It's a double auction, meaning there's buyers and sellers. And there's one designated market maker who's charged with maintaining a fair and orderly market. We'll talk about that at length in a little while, right? The specialist or designated market maker in 1792 said to the other members, listen, I've decided to specialize. I'm going to get this post every day. And if you floor brokers are people who execute orders for clients of member firms. If you have a customer who wants to buy Bank of New York at their price or less, why don't you leave that with me? And if I can execute that for you, I'll do so. That'll free you up to go do other things. That sounds pretty reasonable. And so when New York comes and pitches the board, they say, hey, why don't you come to New York where we have a designated market maker, AKA specialist charged with maintaining a fair and orderly market, making sure there's always a continuous market. If you go with those NASDAQ guys, there's multiple market makers. For example, Facebook has 55 different market makers on NASDAQ, none of whom are charged with maintaining a fair and orderly market. And what gets that market going, test question, the NASDAQ can best be characterized as a negotiated quote-driven market, as is all over-the-counter markets are. I spent the last part of my career in San Francisco before I retired out here to Las Vegas. I'm coming from you in my studio in fabulous Las Vegas. And one of my favorite places was the corner of Montgomery and Jackson. And if you go to the corner of Montgomery and Jackson, there's an old brick building that's been restored to its former glory. It says William Tecumseh Sherman was a market maker here. In the 1850s, he provided liquidity in securities. He would come into his firm there, and over the counter, there would be a chalkboard, and you could look at a particular security and see what the quote was, the bid and the ask, and make a note of that, and you'd walk down Montgomery Street. That's where we're all in the same financial district, no telephones, no electronics. So you could look at the other chalkboards of the other brokerage firms and see what their quote was. And when you got to the bottom of Montgomery and Market, you would then have all the quotes for what people are willing to buy or sell that particular security. Now, as a buyer, you're going to pay the high price, but you want the lowest of the high. As a seller, you're going to receive the low price, but you want the highest of the low. So you'd be able to figure that out. By the way, you don't have to walk back up the street. You could just say, hey, listen, here's the quote from Billy. If you honor it, I'll do business with you. The first job you get is a chalk boy, and your job would be to climb a ladder and change the quotes on those particular securities. Now, NASDAQ stands for National Association of Securities Dealers Automated Quotation System. All that means is that chalkboard is now, hooked up electronically, telephonically. So, all debt-denominated securities trade over the counter. Some securities trade on NASDAQ, but there are two other over-the-counter markets we'll be discussing, the bulletin board and the pinks. And those are all over-the-counter markets. Because in those days, literally what I would do is give Billy the money, he'd give me the security over the counter. Or I'd give him the security, he'd give me the money over the counter. But now we're all hooked up telephonically and electronically. And the test question is to be able to distinguish between negotiated quote-driven markets and auction markets. You don't have to be as a consumer as concerned in auctions where they're just matching buyers and sellers, right? I joke about Sotheby's and Christie's. Those are auction houses. They don't have art in inventory. They're just matching buyers with sellers. You should be a little more concerned if you're doing business with an art dealer, right? I mean, their interest and your interest are not the same. And as I said, we'll go into more depth on that later in the lecture. All right, so broker-dealers' role in the secondary market. Prior to 1975, commissions were fixed. It didn't matter where you did a trade. It didn't matter because we all charged the same price. All of us charge 2% coming and 2% going. That's called 4%. And we said, if you're going to charge somebody more than 5%, you ought to have a good reason. And there are good reasons and bad reasons about why you might depart from that. What it amounts to is that all broker-dealers have to have a normal pattern to their charges. And if we depart from that normal pattern, we got to have some very good reasons. There are good reasons and bad reasons, like here's a bad reason. You're particularly high maintenance, so for you, up 200% on the commission schedule. Not good. Or, your last trade of the broker month, and I got to make it up on someone. Not good. By the way, we got rid of the 5% policy. It still, exists, but now, as I mentioned, you can charge anything you want less. Before, but you couldn't charge anything less than 2% coming and going. I highly recommend that if you're into it, two great memoirs that have recently been published. Charles Schwab's memoir called Invested, and Joe Ricketts' memoir, founder of TD Ameritrade, called The Harder I Work, the Luckier I Get. Both of them were the first two of the first broker dealers that when we got rid of this mandate that you can't charge less than 2, they said, well, if I don't have to charge 2, I guess I won't. And they were first into what we call the discount brokerage business, which didn't exist prior to 1975. Because the way we win clients, it wouldn't matter if you bought 100,000 from me or my competitor. We're going to both charge you $2,000. So the way we win business is to schmooze. So all of us, the technical name for a broker term is a broker dealer. In any one secondary transaction, the broker dealer is either going to act as a broker or a dealer. The way I think of it, the way Dean thinks of things isn't testable, but brokers act as agents for commissions. This is the firm that we're talking about, Some people like to think of that as ABC, agent, broker, commission. So they act as an agent and they charge a commission. For example, a lot of firms are what we call order entry firms, meaning they do not have securities in inventory. For example, TD Ameritrade doesn't have securities in inventory, Robinhood, Schwab. And so they're going to contact another firm, some other firm who does have the security. And in doing so, they're going to charge you a commission. By the way, the test does not reflect that you can do commission-free trading. There's no such thing on the test. So transactions do indeed cost money on your exams. So we're going to act as an agent for our customer, broker capacity, we charge a commission. Now, the counterparty who we do the trade with is not on the confirmation, but that is available upon request. So, if you call up Schwab or Robinhood and say, I see you acted as my agent in the transaction. Who is the counterparty? Who is the other side of the trade? You're confused if you call up and ask about that in a transaction in which we did not act in our broker agency capacity. Goldman Sachs, for example, Merrill Lynch, Morgan Stanley. In some transactions, they act in their broker capacity, but in other transactions, they act in their dealer capacity. So I say at Goldman Sachs, I say, listen, in some transactions you do with us at Goldman Sachs will be acting in its broker agency capacity. And on your behalf, we're going to get the security elsewhere. But in other transactions you do with us at Goldman Sachs, we'll be acting in our dealer principal capacity. We'll be charging you a markup or a markdown. In each and every transaction you do with us, we will disclose in what capacity we acted. That will be on your confirmation, and we will never be both in the same trade. I mean, that kind of makes sense. How could I act as your agent in negotiations with myself about a markup or a markdown? No. Right? So in a principal dealer capacity, those are synonymous intellectually. We fill orders from inventory. As a principal or dealer or market maker, we buy into our inventory at the bid, that's a markdown, and we sell out of inventory at the ask, markup. I think a good analogy here would be a car dealer, right? If I go into a car dealer, I say, how much for a Lincoln Navigator? He goes, 90 grand. I go, great, I've got one. Where's my 90 grand? He said, well, Dean, I misunderstood you. I thought you wanted to turn money into a Navigator. I gave you my asking or offer price. And now I understand you want to turn a Navigator into money, 40 grand, and you need my bid price. I said, oh my goodness, what's that? He goes, Dean, that's the spread. The difference between what I buy the Navigators at and I sell the Navigators at. Now, good news for you, Dean, there are other Navigator dealers, right? Again, if I know I'm going to pay the high price, but I want to pay the lowest of the high. And, I'm trade in my Navigator, I'm going to get the low price, but I'd want the highest of the low. I used to like to, when I'm going to the game sometimes, there'd be market makers and tickets. And as you approach the stadium or the arena, you see guys that say, need tickets, need tickets, need tickets. And as you got closer to the arena, got tickets, got tickets, got tickets. P.S. They don't stand next to each other because you would be able to see the kind of the spread, right? Now, I used to warn people when my friends would come with me, I'd say, now, you have counterparty risk that if you buy that ticket here, that, it may or may not work. I mean, my ticket comes directly from the issuer, the Warriors, and there's no doubt my ticket is going to get me in there. It's not a primary transaction. Anyways, markdown, markup. In the first, last quarter of 2016 and the last quarter of 2016, the guy who works the junk bond index, junk bond desk, the bond desk is the persons who buy bonds into inventory and sell bonds out of inventory. So the guy who works Goldman's junk bond desk is the guy who trades from inventory. And in that last quarter of 2016, he made $400 million. No shenanigans, nothing nefarious, but they were asking what happened. He said, well, when President Trump was elected, a lot of people got nervous and they started dumping their junk bonds, and I was the buyer. He said, about 8 weeks in, Towards the end of the quarter, people said, well, maybe it's not going to be so bad. And people wanted to buy junk bonds, and I was the seller. I said, woo, I don't know what his bonus was that quarter, but it should be huge, right? He's the guy who's buying from inventory and selling from inventory. And again, we'll talk about that at length coming up. So that's kind of where we're heading. P.S. I would know that 5% policy. I pulled a couple questions and got some performance opportunities to look at. And I would know that 5% policy does not apply to the primary market. We're talking about the secondary market. That 5% policy is only about secondary transactions. Now, on the front page of a prospectus, we show you what the markup's going to be per share. We show it to you gross and net in terms of the total offering. And typically at 7 to 8%, so way more. You say, Dean, why are you giving me a prospectus? I say, so I can charge you more than 5%. I'm joking. I probably wouldn't say that. Let's clean up our slide. All right, so here we go. This is one I pulled from FINRA's practice exam. It's a very good thing to do if you're taking your SIE. Make sure you go to the FINRA website and do the practice exam. I recommend that maybe you do it 3 times, once after your class, once the night before, once the morning of, just to kind of get your juices flowing, kind of use it as a, kind of recognition flashcard kind of stuff. As I told you, the future lecture, I'm going to cue this thing up and I'm going to do it by sharing the screen and talk about that. But this is where I got this question. I think it's a good one. This is pulled again from the SIE practice exam. When a broker-dealer charges a commission, broker-dealer charges a commission. So brokers act as agents for commissions, or ABC, agent, broker, commission. It is acted as, the answer here is A is an atom. It's acted as an agent. That would be very much something you can encounter on both the 7 and the SIE. Now, if I would have said a broker-dealer charges a markup or a markdown, that would have been B. If I said markup or markdown. Or, by the way, it could have been D, market makers for stocks. But, underwriter is the primary transaction, and that could be depending on the type of offering. So the answer there is A. Here's another example. This is one that I just kind of made up to. That's something I think you could see. So this is a performance opportunity that Dean actually just added to the deck. So the 5% policy applies to all the following, except it doesn't apply to the primary market. That's very testable. I don't know if you'll get it expressed the way I came up with this slide. You'll see expressed some different way, but that's a good example of what you should be prepared for. The answer here is D as in dog. All right, so let's get started. Let's get a little more in depth in the secondary market. If anybody ever asks you about economics, finance, investments, and you want to sound smart, you should say it has a lot to do. You should say it has a lot to do with interest rates. If you just shut up after you say that, you sound pretty good. And so he says, well, what about them? You say, well, they fluctuate. They fluctuate. They go up and they go down. They say, is that good news or bad news? You say, well, it depends. It depends. Here we have recently Ford Motor Company in the primary market issued some 8% debentures. They were M&S. Now, what does M&S mean? M&S means they pay interest March and September. March and September are what we call the dated dates. The dated dates. The dated dates are the date the bonds start to accrue interest for the next time frame. I was thinking about buying these bonds in my retirement plan. 8%, that ain't bad. And if I decide to buy $100,000 worth of these in the primary offering, 8% on $100,000 is $8,000. I would expect to be paid $4,000 on March 1st and $4,000 on September 1st. That's called the dated dates. You should definitely know, test question, that bonds pay semi-annually. Treasury notes, all Treasury notes, corporate bonds, muni bonds, muni notes, well, not muni notes, corporate notes, very testable. No, they pay semi-annually. That is very testable. So this is M&S, but it could have been, J&J, it could have been F&A. These Ford Motor Company debentures that they issued, debentures means these are unsecured. The only thing that's backing these up is Ford's full faith and credit, their promise to pay. They had 10 years to maturity. So assuming Ford doesn't default, they're going to pay you, at maturity, 104 grand, your principal and the last interest check. And 8%, during the pandemic, they got to pay 8%. I mean, that's a lot. But anyways, maybe at some future date, Ford could refinance and they reserve the right to do so. So Ford said, yeah, these bonds are callable in 5 years at par. So if Ford chooses to, 5 years, they could, refinance this debt. Now, the nominal yield is the only yield we're going to be discussing that does not fluctuate. It does not fluctuate. Ford says, we don't care who's got the bonds, we're paying 8%. That does not fluctuate. And when you buy these bonds at par in the primary market, all of these yields are the same. All these yields are the same. Current yield is very testable. Current yield is what an investment pays you divided by what it costs you. I don't know why my annotation tool seems to do that a lot. I got to figure out why it does that. Anyways, you definitely need to know current yield on your exam. Current yield is what an investment pays you divided by what it costs you. All I'm illustrating right now is that 8% is the same. Because what we got to do is, see what happens in the secondary market, the topic of today's discussion, what happens to the secondary market price of the bonds. When I was a practitioner, I would tell my clients, listen, I'm going to make you immune from fluctuating interest rates. We're just going to buy the bonds and we're going to hold them to maturity. If we buy them brand new, we hold them to maturity, all these yields will be the same. So yield to maturity, most people who buy bonds are not interested so much in the price or the nominal yield. What they're interested in is what they'd make by holding the bond to maturity or holding the bond to the call, whichever is more likely. That's kind of where we're heading. And the fancy word for yield to maturity is known as the basis. The basis, your basis is 8%. So if I buy these Ford Motor Company debentures brand new at par and I get back par at maturity, I haven't made nor lost any money to maturity. All I made was my 8%. If the bonds are callable in 5 years, if I buy these bonds brand new and they get called in 5 years, I didn't make any money by holding the bonds to the call. All I made is 8%. What we're illustrating is that when you buy a bond at par, all of these yields are the same. Very rarely do people buy bonds. Very rarely do people buy bonds at par. What happens is interest rates fluctuate. Interest rates could go up. And if interest rates go up, the bond price is going to go down. I've drawn a flat line here to represent what I'm going to be offering you here in this slide is what's called the seesaw or the teeter-totter. And what I love about the seesaw or the teeter-totter is it turns judgment questions into aim and shoot, point and click questions. And anytime I can do that, I'm a huge fan. So, one thing you might want to consider is when you come into your exam is draw a flat line, which represents a bond at par and all these yields being the same. So let's say that interest rates go up and this thing goes down and now it's trading at 90. Very testable. Bonds in the secondary market trade as a percentage of par. Bonds in the secondary market all trade over the counter, meaning there's going to be a bond desk, and they all trade as a percentage of par. Par in this case is 1,000. And so 90% of 1,000 would be $900. And what we want to look at now is what would be the relationship of these yields. What we're going to have to do on the test is they're going to give me yield and want me to find price. Or on the exam, they're going to give me price and want me to find yield. And so the teeter-totter or seesaw is a great way to be able to do this. Now, you don't have to be able to crunch yield to maturity and yield to call. But you do need to be able to crunch current yield. Current yield is what an investment pays you divided by what it costs you. Now, by the way, I know it's got to be a number that is greater than 8%. So I'm going to get out my calculator. What it pays me is $80 in annual interest. What it cost me was $900. And so the current yield is 8.8%. By the way, on your exam, you could get rid of anything offered to you anything offered to you that isn't, something, greater than 8. It's whatever it is, it's got to be greater than 8. By the way, that nominal yield also on the test is called the coupon. It's also called the fixed or stated rate of return. What will they call it? Whatever you're not prepared for. In the old days when Ford would issue these bond certificates, there'd be coupons attached, and you'd actually clip the coupon. In my example, I bought $100,000 worth of the Ford Motor Company debentures, and on March 1st, I'd clip that coupon, take it to the paying agent. They give me $4,000. I was dealing $4,000, $100,000 times 8% is 8, 2 semi-annual installments. Nobody does that anymore. Bonds today are fully registered, but we still refer to that as the coupon rate or the fixed or stated rate of return. And it's the only yield we're discussing, by the way, that doesn't fluctuate. Because Ford says we don't care who's got the bonds, whoever's got them, we're paying 8%. So that doesn't fluctuate, but these other ones do. Now, one thing that's very testable is we always should quote yield to maturity, yield to call, whatever is more likely or what is lower. And so here we should be quoting to the customer yield to maturity. That's what he needs to make sure is attractive. You're considering buying these bonds. You say, Dean, I see that I can get a bond of similar credit quality and similar length of maturity in the primary market that pays between 9 and 10. And this Ford Motor Company debenture that we're looking at, if I pay the offer price of $900, it only pays 8. I said, well, you're focused on the wrong thing. You're comparing an apple to an orange. What we want to do is figure out what is the yield to maturity or basis. And if that number is attractive, you don't have to do that. But if you did that math, that's 9.5%. That's not testable. What's testable is it's higher than this number, and it's the number that needs to be quoted to the customer, make an informed decision. So if you're trying to decide when they want to buy new in the primary market or used in the secondary market, again, it's based on value. And if you find that 9.5% to be good value, maybe you want to pick up these Ford Motor Company debentures for $900. Now, I'm assuming they still have 10 years to be able to do the illustration. If we did the yield to call, we'd find out that's 10.5%. But that's not likely because, typically you're not going to refinance it. The insurer is going to refinance at a lower rate. So what will I ask you to do on the test? What I would ask you to do is this idea here is give you a yield and make you come up with the price, or give you the price and make you come up with the yield. So let me show you how we test you on that. So first thing we do is we come into the test, we draw a flat line which represents a bond at par. They say your client is considering buying a bond at a discount in the secondary market. Your client is considering buying a bond in the secondary market at a discount. Is the yield to maturity higher than the nominal yield? Same as the nominal yield? Less than the nominal yield? Cannot be determined. I hope you remember telling you don't ever take cannot be determined. That is never the right answer on the exam. Never the right answer. And you say, oh, well, the yield to maturity is going to be higher than the nominal yield. And by the way, I wouldn't worry about this one. I shouldn't quote that to them because that's not a meaningful number. We always quote yield to worst, right? Or the other version of this. Your client buys a bond with a yield to maturity greater than the nominal yield, greater than the nominal yield, greater than 8. Not so much, what is that number? This number, the relationship is higher. Is he considering paying a discount? You don't have to come up with the 90. You just got to come up with something less than par or premium, or cannot be determined. Whatever I tell you about that, don't ever take the cannot be determined choice. That's never the correct answer, right? So either price to yield or yield to price. And so what we've said here, let's just make a little note to ourselves. If I haven't said it, you probably should have a pen and paper whenever you're doing one of these lectures, is discounted bonds. We buy bonds at discount. The nominal yield is going to be less than the current yield, which is going to be less than, by the way, remember that's from grade school. Let me finish this up. And what we should quote is yield to maturity, whatever is lower. So the teeter-totter turns this into a, aim and shoot point and click question. Big fan of that. So we said that if interest rates go up, the bond price is going down. Now, what's the other scenario? The other scenario is that interest rates go down, causing the bond to go up. And now it's trading in the secondary market at something more than that. It's trading at a premium. Maybe it's trading at 110. 110 would be 110% of par. That'd be 1,100. And again, what we want to do is we want to draw our flat line, which represents a bond at par. And then we say, okay, let's look at now what these various yields are going to look at. P.S. Very important now, it's very likely that these bonds are going to be called. It's very likely because, you know, Ford can refinance at today's lower rate. There's two things that are preventing Ford from refinancing. Actually, in this case, there's only one thing that's preventing them. It's the call protection period. You know, Ford can't call these bonds away from the bondholders for at least 5 years, but if they do so at par, usually there'd be some kind of a prepayment penalty of some sort. But here it's callable in 5 years at par. Now, the only number we have to be able to crunch on the test is the current yield. You know, what it pays us divided by what it costs us. And we come up with 7.3. Right, we take our calculator, what it pays us. How am I getting the 80 per bond? 8% on 1,000 is $80. I divide by 1,100, then 7.27, 7.3. Rounding will not cause you to miss any question. And that's important because that means this number is going to be lower and this number is going to be lower still. You know, the one yield that doesn't change is the current yield. Now, very, very testable. This scenario is more testable than the other one because now what I need to quote is yield to call. Now, the test believes in human depravity and original sin. What I mean by that is the test assumes I might call you and say, hey, brand new bonds only pay between 5 and 6. I've got some Ford Motor Company debentures in the secondary market paying 8. And you say, well, Dean, don't I have to pay a big premium for that? I said, well, you're no fun. You said, Dean, really, should you be quoting the nominal yield to me? I said, okay, well, current yield 7.3. You go, well, Dean, should you even be quoting that to me? I mean, if I did the yield to maturity, we have a built-in loss here by holding the bond to maturity. If we buy this bond for 1,100 and Ford only gives us back 1,000, we're going to lose $100 over the remaining life. You know, we have to adjust that into our return. Now, if you did the math, we don't need to do the math. We'd find out that that's like, 6.5. And again, the reason that's not important is because it doesn't look like you're going to be able to hold this to maturity. Now, you still may, after doing this, you may decide you still want the bonds. If we actually did the yield to call calculation, it would pay 5.5 to the call. P.S. brand new ones pay between 5 and 6, and so does this. That's the whole point of this, by the way, is to compare not apples to oranges, but primary to secondary, but what people are mostly buying the bonds. If you find 5.5% yield to call to be attractive, then by all means, maybe you want to consider doing this. Now, what I've shown you here using the teeter-totter is that when you buy a bond at a premium, the nominal yield is greater than the current yield, which is greater than the yield at your maturity. Remember, the fancy word for that is basis. Let's just put that in there, which is greater than the yield to call. The test question is the lowest yield, and that's what we should be concerned with, is the yield to call. That's what we should be concerned with on the exam. All right, so let's clear the thing here and let's play the game they love to do. Remember, price to yield, or yield to price. That's what they love to do. Now, sometimes I get serious math geeks who say, Dean, I don't like the teeter-totter or seesaw because that relationship isn't linear that you're showing it is on the teeter-totter seesaw. You're right. Bond prices and interest rates have the relationship is called convexity. Who cares? It's not testable, but it's a non-linear relationship. But who cares? We're just trying to pass the test. So the teeter-totter is kind of nice, seesaw, because it turns these questions we're talking about from judgment questions, name and shoot. And so your client is considering buying a bond at a premium. And this is what we're concerned with. We're not concerned so much with the numbers as we are the relationship. And as we said, what we're going to ask you to do on your exam is either go from price to yield or yield to price. Yield, one or the other. By the way, we shouldn't quote this to you because that would be deceptive to quote yield to maturity with you because it's not likely. You're supposed to quote yield to worst. And the yield to worst on a bond at a premium is yield to call. And so let's play the game. And by the way, again, not testable, but this game is called interpolation. And we're taking the price. Your client's considering buying a bond at a premium. Your client's considering buying a bond at a premium. Is the yield to maturity less than the nominal yield? Same as the nominal yield? Higher than the nominal yield? Cannot be determined. And you'd say, well, yield to maturity is less than the nominal yield. Or the other version of this question. Again, so if you're going to take me up on the offer, maybe you want to come into your exam site, draw your flat line, which represents a bond at par. And the other version, remember this, is to go the other way. Your client's considering buying a bond with a yield to maturity less than the nominal yield. Is your client considering paying a premium, par, discount cannot be determined? And you would say he's considering buying a premium. And so we love that. You know, that's worth 2, 3, 4 points on both the SIE and your Series 7 top off. And what we said is when you're buying a bond at a discount or par, we should quote yield to maturity or basis. Those are the same things. And we said when you're buying a bond at a premium, you should quote yield to call. All right, so flat line is pretty cool. Pretty cool. Lots of, by the way, when you're trying to decide how testable something is, you can kind of make that decision by how long does it take Dean to push a slide. You know, if it takes me a long time to push a slide, that's a sign that it's probably, you know, pretty important. Anyways, let's show you how they test you on this. So we've told you want to come in. We said there's no draw. No, I'm wishing for you a dream draw. Everything you studied shows up, but there is no draw of your exam. Yeah, sometimes you don't get a dream draw. Sometimes you get a face of death draw, right? I'm hoping for you a dream draw. But I know of no draw of your exam in which you're not going to get tested on the inverse relationship of interest rates and bond prices in the secondary market. That's the title of this lecture, is the secondary market. How do things work in the secondary market? And we said in the secondary market, debt-denominated securities have an inverse relationship with interest rates. We said if interest rates go up, bond prices go down. If interest rates go down, bond prices go up, and then the bonds become more likely to be called. And so very important on your exam. So all debt securities trade over the counter. Now remember what that means? That means there's a bond desk who's going to give you a quote at price at which that person works the bond desk. I'll play bond desk. I'm going to give you a quote. I'm going to give you a bid and an offer or ask, a price at which I'm willing to buy this bond into my inventory, my bid, and a price at which I'm willing to sell this bond out of my inventory, my ask or offer price. So all over the counter markets, test question can best be characterized as negotiated quote-driven markets. Now, when I give you my quote here in a minute, I'm going to play bond desk. It doesn't mean you have to do business with me. You can say, Dean, I'm going to buy 500. How about you give me another eighth or another quarter off? You know, who knows? I may or may not do that. All right, so here's an example of a quote from a corporate or municipal bond desk. So remember, this is very important. And so let's just get out our annotation tool. Very important. You know, this is the price at which the dealer buys. And this is the price at which the dealer sells. You know, whenever a customer is looking at two prices, the customer always pays the high price and always receives the low price. What is that called? The securities industry. So let's just assume this is the quote. I work the desk at Goldman. Goldman makes a market in the Ford Motor Company debentures. And so you say, Dean, I'm interested in those Ford Motor Company debentures, the 8%, you know, of those bonds. You know, well, let's just put this up here. And so I'm going to give you a quote. And the customer sells at that price, and the customer buys at that price. You know, the quotes are always from the dealer's perspective. And so I'm willing to buy this into my inventory at 102.25. I'm willing to sell it out of my inventory at 102.5. That's how the bond desk would do that. Now, it doesn't matter whether you're another broker or a customer. It doesn't matter. If you're E-Trade, I said, well, then I guess you buy it from me at 102.5 and you charge your customer commission. So it's always from the dealer's perspective. Sometimes the way we say that it's a wholesale quote, it does reflect that you might be paying a commission as well. I mean, if you're actually a Goldman customer, you wouldn't be paying this. Now, if this was a muni bond, that quote would be no different. But man, there's 40,000 issuers of municipal securities with $4 trillion in debt outstanding. There's about 10,000 corporate issuers of securities. So if you say, Dean, I'm interested in a quote on Washington County GOs, there are 38 Washington counties. You say, Dean, I'm interested in Orange County. I said, well, Orange County, Florida, Orange County, California, Orange County, New York. One thing we might want to know is, what is the QSIP? Every security has its own unique identifying number known as a QSIP. And then we know that we're talking about the same security. You don't need to know that that stands for Committee on Uniform Security Identification Procedure. And now we know that we're talking about the same security. So I might want to say, what's the QSIP on that? If you get that as a test question, they'll say each security has its own unique identification number known as, and you would come up with a QSIP. One of my favorite, persons in the securities industry, SEC chairman, was Chairman Levitt. And Chairman Levitt, when he retired, wrote his memoir, Taking on the Street. And he said, I'm proud of the fact that I decimalized the stock market. And as a result of decimalizing the stock market, market makers make tens of billions of dollars less than they did before my tenure. Now, he tried to decimalize the bond market, but the bond guy said, no, we ain't going there. So my minimum spread in trading in the secondary market in corporates and munis is 1/8. That's the minimum spread I'm ever going to make trading in the secondary market. We said that bonds trade as a percentage of par. We said bonds trade as a percentage of par. And so in this quote of 102.5, what we're talking about that is 102.5% of par. What we got to be able to do on the test is turn that into a dollar price. We have to be able to turn that into a dollar price. So I think the easiest way to proceed is to say, okay, well, I know that 1% of par is kind of easy. What I mean by that is if I take 1% of $1,000 par, I find out that that is $10. And that is called, test question, a bond point. A bond point is $10. So nobody in the bond business is ever going to say, 1%. So I think that makes now our job a little easier. What I mean by that is, now let me give myself a different color here. The 102, I think, is pretty easy. We say, well, 102 would be 1,020. And then all we got to do is figure out what is 1/2 of 1% of par. Oh, yuck. That's a mental mess. 1/2 of 1% of par. I think it's easier to say, well, if 1% of par is 10, then 1/2 of $10 would be 5. And what you got to tell me is that your client would pay $1,025 for that bond. If we had, 1/8 would be $1.25, a quarter, 3/8, 1/2, 5/8, 3/4, 7/8. Those would be the various ones we have here. And so this is 1/2, and 1/2 is $5. This would be $1.25. That'd be $7.50. I just think that's easier. Now, be careful. It's very testable to know, either one, right? If the customer is buying, he's going to pay the high price. But if the customer is selling, he's going to pay the low price. And so we might have to turn this into a dollar price. And again, I think the percentage on the number, the full number, is pretty, I think, transparent. What I mean by that is I think you should be able to get to that 1,020 pretty quickly. And then you got to figure out what is either 1/4 of 1% of par. What a mental mess. But if you just say, okay, well, 1% of par is $10 at the bond point. And so 1/4 of $10 would be $2.50. And you would tell me that your customer, if you wanted to sell this bond, would get 102 250. And remember what we call the difference between those? That's my spread. So my spread here is a quarter point or 250. I'm hoping every time I buy and sell the bond, I want to do it as quickly as possible. That's how I make my difference between what I buy at and what I sell at. So this is called the mark down, right? And this is the mark up. And the difference between those is called the spread. And that's how we do that. Now, by the way, if I have these Ford Motor Company debentures in my inventory, and you say, Dean, what's your quote? And I say, my quote is 102 and a quarter, 102 and a half. You say, Dean, I'm buying 100. You can negotiate. You say you're buying 100. So, that's 102 and a half, which we said is 1,025 times 100 bonds. So that's $102,500 that you owe. But besides that, you also owe me some additional money because, on March, remember these are M&S bonds. On March 1st, you're going to get a check from Ford, assuming this is the Ford debentures, for $4,000. And that $4,000 doesn't all belong to you because these were my bonds for for September. That's the last time they paid interest. These were my bonds in October. They're my bonds in November. They're my bonds in December. They're my bonds in January. The vast majority of that money you're going to get belongs to me, the buyer. And you say, well, Dean, when I get the check, I'll send you your pro rata share. I say, no. Veritas, we have what's called the Uniform Practice Code. And the Uniform Practice Code, test question, standardizes practices within the securities industry, standardizes trading practices within the securities industry. Veritas, well, you can imagine what a mess the securities market would be if everybody was conducting business differently. And one thing we agreed to is when we agree to terms, that's called the trade date. Trade date is when we agree to terms. And we all agree that we're going to settle. That's when ownership changes hands in the secondary market for corporate munis on what's called T+2. That's called regular way settlement. And we always assume that people are doing business the regular way. That's why we call it regular way settlement. There are irregular ways to settle trade, but we don't assume you're doing that. Now, one of the things the Uniform Practice Code says is that buyers of bonds are going to pay sellers of bonds. Let me put this over here. We have some more room. Buyers of bonds are going to pay sellers of bonds the dollar amount of accrued interest. So besides the price you negotiated for this bond, 102 and a half, you're also going to have to pay the accrued interest. The buyers are going to pay the sellers the dollar amount of the accrued interest. Now, when we came up with the Uniform Practice Code, we didn't want our high talent men and women to have to remember nursery rhymes and knuckle humps about how many days have September. And so we agree when trading corporates and munis that every month has a 30 days, and that means the calendar has 360. That makes less work for that. So in my example, you owed me for all of September 30 days, all of October, all of November 30 days, December 30 days, January 30 days, February 30 days. And we calculate up to, but not including settlement. So we calculate accrued interest. It makes sense we don't include settlement because that's when ownership changes hands. So we calculate up to, but not including settlement. I'm not going to show you an example of a practical application example of this because I don't think it's something you're going to have to actually do on your exam, but I have a shortcut for that. And again, in the comment box of the video, if you'd like to see an example of actually calculating that, just say in the comment box, Dean, can you show me an example of how to calculate the number of days? I'd be more than happy to show you that to you. Mainly, this is just recognition. Let's make sure we say that T+2, we understand that's for corporates and munis. There's other different types of settlements besides corporates and munis. All right, so We get everything there. Yeah, cool. All right, so let's move on. This is a question that I actually made up here. And the reason I made up this question is I want to show you how you use the teeter-totter to figure out, what bond is trading at a premium, because that's the one where, remember, you have to quote yield to call. By the way, the MSRB, the Municipal Security Rulemaking Board, says that you must quote yield to call. And so, what I do is I take my teeter-totter and I just go through these. And what I'm looking for is a bond that is trading at a premium. And so I say, okay, well, let me look at this first one. There's my flat line, which represents a bond at par. And there's my nominal yield. And there's my basis. And so, no, not a problem here because that's a bond at par. So that's not a problem. Let's see my next one. I draw my flat line. There's my nominal yield. Remember, that's the triangle. That's the fulcrum on the teeter-totter. There's my current yield. There's my yield to maturity. There's my yield to call. It tells me 4.5 at bond. It's like learning a foreign language, by the way. They say when you dream a foreign language, that's when you know it. And so, we don't say 5%. We say the 5. So that means 5%. So that's the nominal yield. And this is the yield to maturity. And so here the nominal yield is 4.5 and the basis is 5. And so this is a bond at a discount. The nominal yield is less than the yield to maturity. And so though that we don't quote yield to call on that, we quote yield to call, remember, on the bonds at a premium, because it's very likely those bonds are going to get called. Long ago in a far off galaxy, when I was a baby broker, I was calling this guy. I was trying to get him to buy some muni bonds. And my competitor's bond had a much higher yield than mine. It was like, almost 100 basis points, 1%. That's 1% in bond speak. Like I'm offering a bond that pays, 5 and my competitors pay 6 on a yield maturity basis. I said, man, I'm usually more competitive than that. I don't know what it could be. I mean, it could be that I'm just marking it up and knocking down the yield. I could be. I know that's not it, because if that was it, I would know. There's got to be something we're missing. I said, listen, I didn't go over the yield to call with you. And the reason I didn't is because if my bond gets called, you'll actually make even more money. It's a higher yield. And that's why I'm quoting yield to maturity. Do me a favor. Ask my competitor, what is the yield to call? Maybe that's it. And call me back. If I lose the business, I'd certainly like to know how. And anyways, call me back. He said, Dean, it was callable next week. Now, I don't know if my competitor was ignorant or malicious, but he shouldn't have been quoting the yield to maturity. He should have been quoting the yield to call because the bond was trading at a premium. I didn't do that. And the reason I didn't do it is because I didn't need to, because my bond was trading at a discount or par, meaning the yield to call will be the higher yield. And remember, we keep saying this, you got to quote the lowest yield the worst. On your exam, you got to believe in human depravity and original sin. All right, so we're trying to figure out which one of these bonds is different from the other. I sometimes call this the Sesame Street trick. And so now we're looking at this bond here. And there's our 4%. There's our nominal, there's current, there's yield to maturity. And it says the basis is 5. And so that too is a bond at a discount. And again, that means I don't have to do that. We're looking for a bond at a premium. All right, so let's look at our last one, because that's where this becomes an issue. And so here's our last one. This one is very testable. There's my flat line. And there's my nominal yield. That's what that is, nominal yield. And there, the nominal. We said, remember, basis is the same as yield to maturity. And it says my yield to maturity basis is 5. Ding, 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 ding. That is a bond trading at a premium. I think that's the most sophisticated version of that you'd get. And to be honest with you, that's more likely on Series 7 than it is, SIE. So the point of that question was, I just want to show you again how we use the teeter-totter to turn aim and shoot point and click questions into, judgment questions, aim and shoot. 3 styles of questions you get are practical recognition. Recognition is like 30-day calendar, 360-day month, T+2. You get practical application, what's the current yield, and then you get judgment questions. That's why I like that teeter-totter. This is another one I pulled from the SIE practice exam. So the last transaction in XYZ, so XYZ is the issuer, and 5.5, remember, it means that's the nominal yield or the coupon. And it's trading at 102. Remember, that's 102% of par. That's 102% of par. So that's 1,020. It's trading at a premium. By the way, it's trading at a premium. So what does that mean? Interest rates have done since the bond was issued. Interest rates have gone down, causing the bond to go up. You know, what would you be interested in this bond? You wouldn't be interested in the yield to maturity. You'd be interested in the yield to call. So that's a good one I pulled from your SIE practice exam. This is another one I pulled from the practice exam. You know, boy, RTFQ, RTFQ. That stands for read the full question. Make sure you're reading the full question. The answer here is A, right? But if I'd asked you about a government security, it would have been D, right? So be careful what you're being asked. So corporate munis, we said on accrued interest, the computation of accrued interest is paid by the buyer to the seller. It's calculated from the dated date up to, but not including the settlement date. It's calculated from, let's just put that, I don't know if I put that on the previous slide. Let's make sure we put that there. Can't hurt to put it again. We calculate accrued interest from the dated date. Remember, the dated date is the last time it paid interest. Dated date up to, but not including settlement. And it makes sense we don't include settlement because that's when ownership changes hands. Here's one that, again, the whole lecture is called secondary market, but we also have a bond desk, the convertible desk. I said, let me talk to the convertible desk. I'm interested in buying this convertible bond. And so the convertible bond desk says, Dean, what you interested in? I tell him. And I say, okay, well, that particular convertible bond is trading, I'll offer to you at 130. So that means I can buy this bond for 130% of par. That's $1,300. It has a conversion price of 40. Ladies and gentlemen, very, very important. Very, very important that you make a very important mental note when you're doing convertibles. Very important mental note. When given the conversion price, I need to establish the conversion ratio. So you can't do any kind of an intellectual kind of conversation without knowing how many shares you can get of this bond. Now, those conversion terms were based when it was issued in the primary market at par. And so the first thing I have to do, what we're trying to figure out here is if I buy this bond for 130 and I convert it into the stock, what would I be paying for the stock? Because that's the point. It may or may not be a good deal depending on, what I'm going to be paying. And so the first thing I'm going to do is I'm going to take par and I'm going to divide by the conversion price to establish the conversion ratio. And that's really important. So first thing you got to do whenever you're taking a practice question or you're doing an exam, is say, I need the conversion ratio. So in this example, par is 1,000, and we're going to divide that by the conversion price of 40. And we find out the conversion ratio is 25 shares. And it's much more important to know how many shares I can get than it is to know the conversion price. So now I'm back in business. So let's just get the calculator, show you what I did there, right? I took par, 1,000, I divided by the conversion price of 40, and I found out that's 25 shares. So that's the first thing. So now the way I'm going to calculate parity, very testable. Some people on your data dump sheet, I don't know if we've talked about this, but if you want to do a data dump sheet, if I told you to get one sheet of paper on it, anything front and back, what would be on it? I'd certainly have my options matrix, maybe my teeter-totter, some of my formulas. But the formula to do this, I'm going to take the current market price of the convertible, and I'm going to divide by, let's give me some more room here. Current market price of the convertible. I'm just going to put CMP. That just saves us some. CMP means current market price. of the convertible. I'm divide by the conversion ratio, how many shares I can get. And that'll tell me what I would be paying for the stock, parity, what I would be paying for the stock. And so let's do that. So I'm going to take a 13, remember 130 means $1,300. And I'm going to divide by the 25 shares. And I find out, let's take my calculator. By the way, you can't be fumbling around. Maybe you're fumbling around in this lecture, but on the actual exam, you cannot be fumbling around with this math. You got to be able to do this as a matter of routine. So I take $1,300, I divide by 25, and I find out that parity is 52. Whoop. So yeah, let's put this into, plain English. If you buy a convertible bond for $130, $1,300, and it's convertible into 25 shares, and you converted, you'd be paying $52 for the stock. Right now the stock is somewhere below 52. Maybe the stock's at 50, for example. If the stock's trading at 50 and you determine the parity is 52, this only makes intellectual sense, economic sense, if you think the stock is going to go from 50 to at least 52. Because by paying $1,300 for this convertible bond, if you convert, you'd be paying this for the stock. Now you also get, probably perhaps more income than you would get from the common stock as well. So this is an lecture on convertibles. I'll do that some other point. This is a lecture on the secondary market, and you're buying a convertible on the secondary market here from the bond desk, and based on that offer price. Now, if you found the stock was trading at greater than 52, woohoo! There'd be an arbitrage opportunity. Boy, if you find that in the real world, give me a call. I doubt you'll find that. So typically, the convertible bond would be trading at a premium to, whatever parity the common is. So the common is somewhere below 52. I can't imagine any draw in which you're not going to have to calculate parity. So by review, the way you get parity of the stock is you take the current market price of the convertible, you divide by the number of shares, and they may or may not give you the number of shares. You might have to establish the conversion ratio. And the way you do that is to reset to par, and you divide. All right, so we're talking about the secondary market. We said all bonds trade over the counter, and then we said there's a bond desk, and we said there's a bond desk for corporate bonds. There's a bond desk for muni bonds. That's the person at the brokerage firm who buys bonds into inventory at the bid and sells them out of our inventory at the ask or offer. We said not every broker dealer makes markets or has a bond desk. Some do, some don't. And if you're a customer of a firm that doesn't, that firm will have to reach out to a bond desk to get the quote and decide what you're going to get when you buy or sell. We said you always get to pay the high price, always receive the low price. We said there's a bond desk for convertibles, for example. And we also have a bond desk for the govies. So I work the govie bond desk at Goldman Sachs or Morgan Stanley or Bank of America. I'm the person who's buying Treasury securities into our inventory at the bid and selling Treasury securities out of our inventory at the ask. Now, I told you Chairman Levitt was unsuccessful in decimalizing the bond market. He tried, but no. The guys who work bond desk said, no, you're not taking my spread away. I'm joking. But we said the minimum spread in trading corporates and munis, we said was an eighth. And in the govies area, it's a 32nd. And another testable distinction is the Uniform Practice Code. Regular way settlement for govies test question is T+1. And a test question for calculation of accrued interest, we use an actual calendar. Remember what that means? That means 365. So be careful what you're being asked. Now, once again, what we've got to be able to do on the test is to figure out what your customer is going to get buying or selling this. And so once again, what's important is that this is the price. The deal. Let me give a different color here. The dealer buys, and this is the price the dealer sells. And it's the opposite from the customer's perspective, right? The customer always receives the low price and always pays the high price. What's that called? The securities industry. I'm joking. That's how we make our living, the difference between what we buy things at and we sell things at. Yet again, what you got to be able to do is turn this into a dollar price. And so I think the 98 is kind of easy. What I mean by that is like 98 is 980, right? That's what that means, 998, right? And then what you got to do is turn the fraction in there. So remember this from grade school, that's 8/32. And remember 8/32 of a bond point, which is $10. And so that 8/32 is going to be 982.50, right? When you have a pizza and there's 32 slices, 8 of the 32 would be common denominator would be a quarter. And then remember, if it's 16/32, you got to be able to turn that into 985. And then you got to be able to tell me on the test, the customer, if he's selling the bond, is going to get this price. And if he's buying the bond, he's going to pay that price. So same deal as we did previously. Definitely need to know all that stuff, how govies, the way I think of it, I don't have cell phone. I think as govies are goofy. They're goofy. They're just different. They're just different. This one's kind of unique. So here's a Treasury bill quote. And this one looks kind of funky until you realize that this is traded. So Treasury bills, test question, are issued at a discount and trade at a discount. So that's testable. And so it looks like Dean is willing to buy this into my inventory at 2 and sell it out of my inventory at 1.5. No, this is a 2%. I'm willing to buy it into my inventory at a 2% discount from face, which is 98, right? If I tell you that something's 2% off, that's a lower price than something that's 1.5% off. And so if you get this as a test question, what they're going to ask you is which one of the following is most likely the quote of a treasury. And you just got to recognize that that one is goofy. By the way, all money market securities trade at a discount except a negotiable jumbo CD. So I'd also know commercial paper is issued and traded at a discount. I would also know bankers' acceptances are issued and traded at a discount. We said this is very testable, very testable. Treasury notes, treasury bonds, wouldn't matter, by the way, if this question, I pulled this from the FINRA practice exam, wouldn't matter if this said treasury notes or treasury bonds or corporate notes or corporate bonds or muni bonds. We said semi-annually. Quarterly would be stocks. Now, if stocks pay dividends, they do. They don't may or may not pay dividends, but they do. They pay quarterly. And monthly would be Ginnie Mae's. Maturity could be all those money market securities, right? That would be T-bills. That would be commercial paper. And that would be bankers' acceptances. They pay you interest at maturity, as well as zero coupon bonds. P.S. I would also know those all trade flat, no calculation of accrued interest. Very much a test question. Now, same day would have been the right answer to cash settlement. Very popular on December 31st. Remember T+1. By the way, that's also true of option contracts. They also are T+1. And remember this one would be corporates and munis. I again pulled that from the FINRA practice exam. All right, hang in there. Remember these lectures, I try and shoot for about an hour. I don't know where I'm at till I hit the end button, but I'm not concerned if I run over because, you know, you have a pause button. You can always in these lectures stop and rewind or take a break, whatever you like. But when I'm recording them, I'm actually going straight through. It's a conscious decision on my part to give you full lectures. So when I decided I was going to, start a YouTube channel, I was going to start posting lectures, be patient with me. I don't know what that YouTube channel, but to be honest with you, I never made a slide deck or did any of this till the pandemic. I'm an old fashioned OG guy who shows up on a corporate campus and dry erase board and teaches this stuff. So your patience is appreciated. But that being said, I've decided rather than give you teaser kind of lectures, which when I was kind of doing my due diligence and seeing what's out there, I'd see a lot of people like pick a lecture and give you like a little parody clip or a little clip on this or a little clip or that. And so by design, I decided to give you full-blown lectures on topics. And so that's a little different in terms of what you might be following on the web in terms of you hit your Google search for videos on SIE or Series 7 Top-Off. Hey, do me a favor, share the link and also, put in your suggestions. Let's get the comment boxes going. That's something I'm trying to get some more interaction on there. I gave a prize to our first subscriber. I'll probably do some more kind of prizes for people who participate, in the back and forth. And, sometimes I forget something in a lecture. And if I do, just send me in the comment box and, hey, Dean, did you mean to say this or whatever? I'll do that. And some of those I told you I'll probably break up lecture 1 and 2. All right. So the last thing we want to talk about, we're talking big picture secondary market, is the secondary markets for stocks. And there are 3 over-the-counter markets for stock. There's the preeminent market for stocks, NASDAQ. But there's also what we call the bulletin board and the pinks. And then when we're talking about stocks and we're talking over the counter, there are market makers, and test question, they provide liquidity. What I do is I turn your money into the security or your security into the money. Before I retired, I sat on the baseline of the Golden State Warrior games, and I was a little market maker there. I, provided liquidity and tickets on the baseline. I would buy tickets at the bid and I'd sell the tickets at the ask, right? Provide liquidity. And then how would Dean make his money? The spread. Sometimes I would have inventory risk. Sometimes I would not have inventory risk. Very similar. My buddy, this was the 90s. And, I used to go to Chicago in June from the 90s for board of directors meetings. And you could rest assured that in June in the 90s, Chicago Bulls are going to be playing for another ring. Anyways, my buddy said, I said, I'm going to the game tonight. He said, no, you're not. The stadium is sold out. I said, Joe, the stadium is not sold out. At some price, there is a ticket. And I don't care what the price is. I'm more interested in the ticket than I am the price. And he said, well, I'll go for $2,000 or less. I said, well, you may or may not be at the game this evening because you're telling me price is more important. Now, in a future discussion, we'll talk about types of orders. But for right now, I'm going to call a guy, a ticket broker, who's like a market maker who provides liquidity, and say, hey, what's your asking price to go to the NBA championship game tonight? He buys his tickets at the bid and he sells them at the ask. And then we have order entry firms who do not have inventory. Again, Robinhood, E-Trade, Schwab, and some firms do, some firms don't. So if I'm a market maker, this is very testable. I'm a market maker. I provide liquidity in this over-the-counter stock. And you say, Dean, what's your quote? I say, my quote is 14.05, 10 by 11. So same example as previously. What I mean by that is, once again, you got to know what the market maker buys at. MM means market maker. And what the market maker sells at. These quotes are from the dealer's perspective, the market maker's perspective. And we said, remember, a customer is always paying the high price and always receiving the low price. And 10 and 11 is the size of my quote. Those are round lots. So what I'm saying right now, it doesn't matter, by the way, if you're my customer or an order entry firm's customer, it doesn't matter. If I work I'm a market maker, and I tell you my quote is 14.05, 10 by 11. That means I'm willing to buy 10 round lots into my inventory. A round lot is 100. So I'm willing to buy 1,000 shares into inventory at 14. I'm willing to sell 11 round lots, 1,100 shares out of my inventory at 14.05. You said, well, Dean, I'm calling on behalf of our customer. I said, well, who cares? I'm joking, but so you charge your customer a commission, right? You say, as his agent, you contacted me, the market maker. Now, if I'm like Morgan Stanley or Merrill Lynch and you're a Merrill customer, you'd buy this at 14.05 with no commission, right? I'm not going to do both. So I'm going to charge a markup or markdown. Now, by the way, if you say, well, Dean, we're selling 500 shares, I would have to honor that because I said I was good for that. Right. So I have to honor that. If you say, Dean, we're selling 1,200 shares, I don't have to honor that. I said, well, I don't know what you're talking about. I'm only good for 1,000. That's called the size of my quote. Now, I have to honor the size of my quote, very testable. They'll say a market maker fails to honor a firm quote. This is a prohibited practice, is known as, and you got to come up with on the test, backing away. I don't know of any draw on the test in which you're not going to be tested on that. You say, Dean, are you failing to honor a firm quote? Are you backing away? I say, I am. What are you going to do about it? It doesn't do any good to know I'm doing something and not know what to do. You say, well, Dean, under the COP, the Code of Procedure, the COP, I think that's a good way to remember this. I'm going to contact FINRA's Department of Enforcement. I said, well, never mind, you're filled. So the Department of Enforcement at FINRA is the person, test question, who handles trade practice complaints. And backing away would certainly be a trade practice complaint. You know, then they'll send me a thing saying, Dean, we received some complaints that you're not honoring your quotes. Could you come up here and explain yourself? So that would be a market maker in this over-the-counter stock. Now, we're not sure if this is a NASDAQ stock or a bulletin board stock or a pink sheet stock, but, you know, that would be the quote. Always from the dealer's perspective. Remember the difference between those is my spread. And then remember the 5% policy. I'm not going to make you calculate. I see a lot of people, you know, telling people you got to calculate. You don't have to calculate percentage markups or markdowns on your exam. You just got to recognize where the 5% policy does or does not apply. I like this. This is the one I pulled from FINRA, right? So the practice exam, very much, by the way, same as Series 7 guys. So if you're a guy or gal for your Series 7 top off, same question. You really, if you're, you know, doing your SIE and moving on to Series 6, well, then you don't need to know the much depth and quantity as you do if you're moving on to your Series 7 top off. But as I mentioned, you really want to make a good down payment on the SIE if you're going to be doing your Series 7 top off, because it's the same stuff with just a little more depth and quantity. But this is very much a test question on both of those. So again, market makers, from the market maker's perspective, I post a quote 10, 10, 10, 25 by 10. Now, what that means as a market maker is I'm willing to buy 25 round lots, 2,500 shares into my inventory at my bid. Let's put that on there. You know, you might want to make your own kind of notes to something as you're doing it, right? So remember, this is the market maker buys. I can't tell you how many people get hung up on this, even people who are taking their, you know, Series 24. We have to spend a lot of time on this stuff with them. And, you know, I think it's worthwhile, by the way. I think it's worthwhile to put here, market maker. Let me get a different color here. Customer sells, customer buys. All right, so let's see what they want to know. Which of the following actions is the market maker willing to take? So before we do this, remember, very testable. I'm posting this as my market maker. So I'm, as a market maker, willing to buy 2,500 shares into my inventory at 10. I'm going to sell 1,000 shares on my inventory 10, 10. So is the market maker willing to take? I'll sell 1,000 shares at 10. No. I'll sell 1,000 shares at 10, 10. So we can get rid of that by process of elimination. We can get rid of that one. I'm willing to buy 2,500 shares at 10. Yep, that's true. Yep. And I'm willing to sell 1,000 shares at 10, 10. Yep. Ding, 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 ding. Very much a test question. I like that one. Again, I pulled that one from the FINRA practice exam. What if I did not? What's that called? Backing away. Here's another one I pulled from that. So we were just looking at one where it was 10, 10, 10, 25 by 10. That's the one we just looked at. So in the over-the-counter market, the term spread refers to the difference between the bid and the ask price. Very much a test question. That's another one I pulled from the practice exam. This is one that I just made up myself. These others could have been test questions. You know, selling away is when you sell an investment not sponsored by your broker dealer without permission. That's not this one, but that could have been an answer to a different question. You know, distractors are the technical name for wrong answers. And, you know, they're pretty good at coming up with wrong answers that sound good. So Interpositioning is putting a third party in a trade, and front running is trading ahead of customers, but this is backing away. Here I've given you all the market makers in a particular security. All of the market makers in this particular security. There's only 3 because if there was another one, there'd be in here. And so we see the ticker here, the identification market participant ID. It's kind of like a vanity license plate. So that first market maker is Merrill Lynch. And Merrill Lynch is willing to buy this particular security into its inventory at 17 and sell it at 17.10. And they're good for 10 round lots either side, 1,000 shares. MSCO is Morgan Stanley. Morgan Stanley says they'll buy 1,300 shares at 1703 and sell 1,200 shares at 1713. And Goldman Sachs says they'll buy 1,400 shares at 1705 and they'll sell at 1711. So you work for the order entry firm. So this is kind of like what I call an exhibit question. We're looking at an exhibit and you work the order entry firm. If your customer wants to sell, which one of these market makers should you contact? You say, well, if my customer is selling, he's going to get the low price, but I think he'd want the lowest or the highest of the low. And if my customer wants to buy, he's going to pay the high price, but I think he'd want to pay the lowest of the high. And so that would be what we call very testable, the inside quote or the inside market. The inside quote or the inside market is the highest bid and the lowest ask. The highest bid and the lowest ask. I'd be prepared on your exam. Let me just clear this up. Based on this exhibit, I'd be able on my exam to know what is the inside quote. The inside quote is the highest bid and the lowest ask. So based on this exhibit, I would be able to look at this exhibit and say, okay, well, the highest bid is 1705. The lowest ask is 1710. And the size would be 14 by 10. Now, by the way, if this is a NASDAQ security, there are data feeds you subscribe to, Series 7 only, but level 1 NASDAQ feed shows you the inside quote. A level 1 NASDAQ feed. If this is a NASDAQ security we're looking at, level 1 would show us the inside quote. You know, I might even frame it that way. You're looking at this as level 2. Level 2 actually shows you the market makers and their quotes. And level 3 lets you play. So maybe I decide I'm going to be a market maker. Here comes Dean. And if I have a level 3 machine, I can put my quote in there. Watch out, world, here Dean comes. To be able to show up on that screen and make a market, I have to have a level 3 machine. So the way I think of it is level 1 shows you the inside quote. Level 2 shows you the players. Level 3 lets you play. Wow. You know, I saw these guys on this ground floor of which is mainly retail, but it looked like they were market makers. I couldn't stand it. I finally poked my head in one day. I said, hey, is that a level 3 NASDAQ data feed? They say, yep. I said, well, no doubt they're market makers. Here's an example of how we might test you in that. So I told you this is a Series 7 question. Level 1 shows you the inside quote. Who knows what the question is? I mean, this is the answer set. If I say which NASDAQ data feed shows the inside quote or inside market, you should definitely know that's the highest bid and the lowest ask, and you should definitely know that's level 1. If I show you, say, an order entry firm would subscribe to, an order entry firm doesn't need to, make a market. They just need to see who has the quotes. That'd be level 2. And level 3 would be, and they say, which NASDAQ data feed would a market maker subscribe to? You'd say level 3. I used to say level 4 is just a distractor, and it is, but I had a guy from FINRA in my 24 class, and I said, there's no such thing as level 4. He goes, well, Dina, au contraire, my friend. He goes, level 4 is what we have in Rockville, Maryland, that overrides all the other data feeds. All of a sudden my quote disappears. They say contact NASDAQ. So level 1, inside quote. Level 2, market makers and their quotes. Level 3 is what market makers have. That's a Series 7 only question. SIEs, you don't need to worry about that. Another Series 7 only question is, how do we report trades? How do we report these trades? And so trace, again, we don't know what the question is. This is the answer set. That's for debt securities. That stands for the Trade Reporting and Compliance Engine. EMMA is the Electronic Municipal Market Access. That's for munis. This is for NASDAQ stocks. That's for the Order Audit Trail System. And I make sure there's no shenanigans. And this is for what we call the third market. And again, I wouldn't worry about this on the SIE. On Series 7, I would be prepared to know which those are for. Those are reporting systems. I would definitely know what is a penny stock. A penny stock, test question, is a non-NASDAQ stock under 5. So be careful here. If it trades on NASDAQ and it's $4, it's not a penny stock. If it's a New York Stock Exchange stock and it trades at $3, it's not a penny stock. So this is a bulletin board or pink sheet stock under 5. That is very much a test question. The definition alone, the definition alone is a test question. So you just got to know that definition. Remember, TQ doesn't mean verbatim it's a test question. It's just expect testable content on that area. And, you know, these are really hazardous to your financial health. So on a solicited basis, if I'm soliciting you for a penny stock, I need to get you to sign a risk disclosure document. I don't have to get you to sign the risk disclosure statement if you're an established customer, and that too is testable. What makes you an established customer? Once you've done 3 trades or you've had funds with me for a year, I no longer have to do that. And test question, you're entitled to a monthly statement. Usually you get quarterly statements, but not if what you have in your account is a penny stock. We said the New York Stock Exchange can best be characterized as an auction order-driven market. We said it's a double auction. You know, I love eBay. I love eBay. It's an auction. But the one thing I don't like about eBay is all it has is sellers. You know, we're talking about the secondary market, and I have a bag fetish. You know, my family makes fun of me, but I love bags. I got all kinds of bags. Now I don't get to travel anymore, so I got a lot of dead capital tied up in this. But one of my favorite bags is the North Face Galeo 3700. You know, and sometimes I'll see one on eBay. I'm trying to corner the market. And somebody will say, you know what that costs new? I said, I do, but you can't get it new. You and I both know that. So here's what I'm willing to pay you in the secondary market. Now, I wish I could just show up there with my buy limit and say, if you have a North Face Galeo 3700, my buy limit is, you know, $200. I'm willing to buy that. Are we cleared? eBay is a single-sided auction, but New York is double. It's got both buyers and sellers. The limit orders are what going to determine the inside quote. So the quote on the New York is not coming from market makers who have inventory. It's coming from the limit orders that the specialist is holding. You know, the specialist in 1792 said, gentlemen, every day between 9:30 and 4 o'clock, you can find me here at this post. And as you, a floor broker, have a customer who wants to buy or sell Bank of New York at their price or better, why don't you leave it with me? And if I can get that for them, I'll do so. That'll free you up to go do other things. And so that's different. Now, he can trade for his own account and does, the specialist or designated market maker, but he has to do so at the better than the limit orders he's holding. The designated market maker provides liquidity, and as I mentioned, is charged with maintaining a fair and orderly market. That is not true of the NASDAQ guys. You know, the NASDAQ men and women like, you know, unfair and disorderly markets, just as long as they come up on top. Oops, sorry, I'm having problems here with my. So that's one of the New York things when they go to do the board, say, hey, you know, if you come with us on New York, for example, when Uber went public, they chose New York as their market center and Lyft chose NASDAQ. So they're always fighting for listings and, you know, where the stock is going to trade in the secondary market. And so here, what I'm trying to show here is that this is a buy limit. And this is a sell limit. In a future lecture, I will, you know, do types of orders. But if you ask me right now, what's the quote on the New York Stock Exchange stock, I say it's 35.05, 12 by 14. So if you're a seller, I'm going to match you with a buyer. And if you're a buyer, I'm going to match you with a seller. And right now, the specialist could buy this, the designated market maker, at 35.01, or he could sell it at 35.04. He's trapped with what we call the inside quote. The inside quote or inside market. My biggest thing here, I couldn't decide how much depth to go into this thing. And the reason is this kind of bleeds into types of orders in a separate lecture. And so I basically just wanted to, in this lecture on secondary markets, what I want you to take away from the discussion is that New York is not driven by quotes that are posted by market makers who have inventory. What drives in New York is the auction, the quote, the limit orders that are being held by the specialist. By the way, if there's no buyers, he's supposed to buy. If there's no sellers, he's supposed to sell. That's called a continuous market. I'm dating myself, but in 1987, during the crash, all the NASDAQ guys just disappeared. They just disappeared off the screen and they didn't answer their phones. The poor designated market maker had to go to his post and provide liquidity. So, at least he was there, right? At least he was there. A member of a stock, I pulled this from the FINRA exam, responsible for providing liquidity in a security and willing to buy and sell at all times that's the New York guy who's supposed to make sure there's a continuous market. I mean, there's no break. If there's all sellers, he's supposed to buy. If there's no buyers, if there's all buyers and no sellers, he's supposed to sell. Third market definition is listed securities traded away from the New York. So, one of the biggest participants is Jefferies. Jefferies is like Denny's. They're always open, 24/7. So any trade in New York that doesn't take place there, like Twitter is a New York Stock Exchange stock. So any trade in Twitter that takes place elsewhere is a third market trade. When I came into the business in the New York, I said, well, our business model is antiquated, but 80% of listed securities still trade between 9:30 and 4 o'clock. Last time I saw it was 12%. So that means 88% of the stocks are being traded elsewhere. Fourth market test question is direct trading between institutions. 144A is testable. And I could have put this a lot of different places. I chose to put it here. I could have put it, how people organize this stuff is different. It depends on your vendor. It depends on, my lectures, I get to decide where to put things. And so I decided to put this here. And a QIB test question is a qualified institutional buyer of securities. And to qualify to be a QIB, you have to have 100 million or more in assets under management. That is a test question. That is a test question. And what they're allowed to do, 144A, what a QIB is allowed to do, let's put that here, very testable, is they're allowed to buy unregistered foreign and domestic securities. Looks like I missed a O there. So for example, I gave you an example of SpaceX. SpaceX has raised a lot of money. Remember this private placement, Reg D, over $5 billion in selling unregistered securities, but not to the public. Fidelity is a QIB and T. Rowe Price is a QIB, and they both own about 7-8% of SpaceX. And if they want to trade SpaceX among themselves, that's no problem. That is no problem. Now, another test question is about a PIPE, a private investment, and a public entity. It doesn't have to be a QIB that does this, but a lot of QIBs do. And so, I decided to put it here. A private investment in a public entity. Very testable. For example, Berkshire Hathaway is a QIB, and Berkshire Hathaway, Warren Buffett called Brian Moynihan and said, could you use a $5 billion equity investment? And he says, I'm listening. And so Bank of America sold 50 million shares of unregistered preferred stock to Berkshire Hathaway. And that was a PIPE, a private investment. What we mean by private is unregistered stock. The stock has not been registered in a public entity, Bank of America. And it doesn't have to be a QIB, but a lot of QIBs do what are called PIPEs. Doesn't necessarily have to be that. Here I offer the issuer, for example, Tesla has said they're going to sell $5 billion worth of new stock this year. Now one way, if I'm T. Rowe Price, I might call up Elon and say, hey, Elon, I was reading you want to do $5 billion worth of stock. Why don't you just issue it to us directly in a PIPE, and T. Rowe will give you the entire $5 billion now. Of course, we want a discounted price on that Tesla. And then what we do is register it. And we're hoping by the time we get it registered and we exit the investment that we have more money. That PIPE shows up on the SIE, by the way. I've had quite a few people on debrief tell me they got that. So Last thing we got to talk about. I'm kind of running over on my hour. Well, so we're done about the secondary market, and there are rules about control stock sold in the secondary market. And so the first question is, what is control stock? Control stock is owned by control persons. And so control persons, test question, are officers, directors, and principal stockholders, and their immediate affiliates, which are called, affiliates, their immediate family members. Test question, a principal stockholder, somebody owns 10% or more of the common stock. One of my favorite, all-time kind of favorite investors, legends, he's passed on recently, is here in Las Vegas. His name is Kurt Gregorian, and Kurt Gregorian used to make his investments through the Tresendo Holding Corporation. And I can't tell you how many times he would buy 9.9% of the stock and stop. And it's not a coincidence he's stopping at 9.9 because he doesn't want to become a control person who owns control stocks, because then there's all kinds of rules. Mr. Buffett, when he was making his investment in Bank of America, he got 700 million shares as a result of that pipe I talked about. There were warrants attached, and he exercised the warrants, and they were asking him about his other banking stocks. And he said, well, I'm not going to sell them. He's now since sold, but he said, a lot of my bank stocks keep buying stock into the Treasury, and as a result, my proportion ownership rises. And I don't want to be a principal stockholder, so I will sell whatever shares I need to stay under that. He got 700 million shares of Bank of America in the primary transaction, and they bought another 300 million in the secondary market. So now he owns $1 billion. And now Berkshire Hathaway owns more than 10% of Bank of America's common stock. And what that means is Berkshire Hathaway can't just dump that stock. That's now control stock and is subject to the volume limitations of 144. This is very testable. So if you're going to sell the stock now, Mr. Buffett just can't call his broker and say, sell 100 million shares of Bank of America. That would disturb the public marketplace. And so what he's going to have to do is file Form 144 prior to the sale. That form, test question, is good for 90 days. This slide is kind of out of control, but what can I tell you? I'm still getting better at trying to come up with slides. Not my forte, but that is very much a test question. So if we don't do anything over this 90-day period, we're going to have to refile. And then what we can sell, very testable, is 1% of the outstanding shares or the average of the last 4 weeks trading volume. I think a good way to remember that is 144. I can sell up to 1% of the stock or the average of the last 4 weeks trading volume up to 4 times a year, every 90 days. So 144. 1 plus 4 plus 4 is 9 every 90 days. So that's what I can sell in terms of that. Now remember, if I got this directly from the issuer, I'm also going to have a holding period. So this control stock could be both restricted stock and unrestricted stock. Unrestricted stock is the 300 million shares that Mr. Buffett bought in the secondary market. And the restricted stock, remember, is the stock he gets directly from Bank of America. I gave you an example here of a test question. So here's a practical application of that test question. A company has 10 million shares outstanding. So the first thing I'm going to do is times that by 1%. And when I times that by 1%, get my calculator, 10 million shares outstanding times 1%, that ends up being 100,000 shares. So 10 million times 1%. By the way, my arithmetic is terrible. So, they offer you a calculator on the test, and they offered me one. I'm certainly going to take it. Now, the next thing I'm going to do is total up the last 4 weeks trading volume, which 750,000, 300,000, 800,000. By the way, if I was lazy and didn't want to do math, I could actually just know this is going to be over. But I still need to know how much over. Whoop. 325. Well, let's I want to do a better job than that. Remember, so now what I got to do is get the average. So I'm going to take the make sure I got all the numbers here. And so I'm going to take 750,000 plus 300,000 plus 800,000 plus 325,000. I'm going to divide by 4. And I come up with, when I do that, I come up with 543,750. Good news. Looks like that's one of my choices. So very much a test question. Now, by the way, on the test, I'll probably, before I do redo this lecture, as I told you, I post the lectures. Then at some point I'll circle back and do a better job cleaning them up. But I think what I would do is I'd make this distractor a little better, where, I come up with a number that's closer where you just can't eyeball it. Because on the test, I don't think you'd be able to eyeball it. Control persons can't profit from declining stock price, so no short sales for those folks, and they're not allowed to make short-term profits. So even if you think it's undervalued and you go in the open market, I'll use Larry Ellison. Larry Ellison is a control person at Oracle. Meg Ellison is his daughter. She makes movies. Anna Burner Pictures in Hollywood. She's an affiliate. His other son also produces movies. Larry just can't, he owns 25% of Oracle. He can't just call and say, sell 1 billion shares of Oracle at the market. It would destroy the public marketplace. No, he's got to file the form, right? He's also a director of Tesla, and he has 15 million shares of Tesla. Same thing. He's a control person. He has to file the form. He's not allowed to make money from the declining stock price, so no short sales. And even if he buys it in the secondary market, which Larry did, he bought his 15 million shares of Tesla in the secondary market. Previous owner received the proceeds, which I was surprised because I thought he would have done a pipe and got it directly from Tesla. But oh well. Anyways, are we clear? He's not, even he got in the open market, not going to be able to buy and sell, make a short swing profit. He does, he's going to have to disgorge the profits back to the issuer. And so that too is a test question. A lot of insiders, control persons don't know that. By the way, that rule applies to Larry's daughter and his son as well. All right, so that concludes this lecture. I think I went a little over on the hour. I'll find out when I hit the end button. Remember, put your comments in the video box if it's a question about a particular lecture, if it's future lectures, whatever you want to know on any exam. I'm your guy. I teach them all, so you put that in the general comment box. And so that concludes this one. I still haven't posted the lecture 4 multiple option strategies. Haven't done types of orders yet. Haven't done the SIE practice exam. So again, my pace is based on my Hotai Media, social media guru. My schedule of posting is once a week. Let's see. So I guess that concludes our time together today. So let's see you on the next one.